80,000 of something at some price. Up to now, I don't know. We're told that the variable costs, are we there yet? No. You have decided to submit a bid to supply the machine screws. It will cost you $780 to install the necessary equipment, which will be fully depreciated in a straight line over 5 years. So as I've said, if it's depreciated, it's capital expenditure, it goes down here, all right? So we're gonna spend $780,000 now. I'm gonna do this in thousands here just to avoid a whole bunch of zeros confusing the issue. Okay. The next thing that tells us it'll be depreciated in a straight line over 5 years. So we can go ahead and figure out what this is. $780,000 $20 over 5 years is $156,000 every year. So this 780 means that we'll have $156,000 in depreciation every year for 5 years. And then we are told that we estimate we can sell the equipment for $50,000 at the end of the project. So that's going to be $50,000 here, minus the taxes I pay on that, right? So let's skip ahead and see what our tax rate is. It's 35%. We're told that this will be fully depreciated, so we know, or meaning it'll go to 0 over 5 years. After 5 years, the book value is 0. So we have to pay taxes on the entire $50,000 because the book value is $0, meaning the capital gain is the entire amount that we sell it for. So this is $32,500. The next thing we're told is that fixed costs will be $240,000 a year. So we can add that here, 240, 240, 240. And we'll need $75,000 in raw material inventory to begin the project. It will stay constant, meaning it will not change over the 5 years. And we have to remember that that also means, as always, we will recover our $75,000 here at the end. All right, we're not just gonna light our warehouse on fire when we're done. Although then you might get an insurance payout, so I don't know. Just kidding. That's fraud. Okay. That's really all we need for this one to get started. We know the 16% cost of capital, so we are where we need to be at this point then. In particular, we can go and say, well, the minimum price I should bid is the price at which my NPV is 0. I should never go below that or I'm losing money. Yeah.
So the net working capital doesn't change in the middle years there?
No. We're told it's constant, so it doesn't change, and then it will be recovered at the end. As I've said, you can assume that will happen. Yeah.
Does that mean you're still spending $75,000 each year?
Could be, but it means you're selling $75,000 in inventory each year as well. That's basically the net change, right? This means on a net basis you're spending $0. Okay, so now we're going to the economic break-even part, which is, again, I'm breaking even means that I neither create nor destroy any value. NPV is $0. We know that NPV should just be the present value of all my cash flows summed up together. In this particular case, we know some of those cash flows. We know what the changes in net working capital are. We know what the capital expenditure is. We know what the after-tax salvage is, but we don't know some other things, in particular net income. Sorry, I'm seeing that I put that in the wrong side of my after-tax salvage. Thanks for letting me do that, guys. All right.
Hold on. So the 75,000.
I had it on the wrong side. That is change in net working capital. This is after-tax salvage.
So much more.
Sorry. See, that's why you ask questions. Sorry, they don't give me a ruled board up here. Life would be a little easier with this sort of thing if they did. Okay. Present value of known cash flows plus the present value of my unknown cash flows. All right, this is the idea behind how we go about this. I know some of my cash flows, I know the total NPV is 0. I can use that information to find what is, at this moment at least, unknown. Now we need to put some numbers to this. My NPV is equal to 0, which is coming from spending $780,000 today, spending $75,000 today on the net working capital.
Don't we need variable costs?
Oh yeah, what's going on up there? I mean, we don't need it yet, but we will. Where's the 850? There it is. All right, so our variable cost is going to come from 150,000 times $8.50 per carton. This amount is, where is that amount on here? If someone sees it, thank you. 1275. Again, in thousands. Okay. So, we'll come back to the variable costs in a moment. However, we need to continue thinking about the cash flows that we do know. So this 780 is our capital expenditure today. This 75 is our increase, our purchase of inventory right now. Nothing in this particular problem happens during the middle years. And then in 5 years' time, we're going to recover the $75,000 in inventory and receive $32,500 after taxes because we sell the machinery. So plus the 75, but discounted now at 16% back 5 years, plus the 32,500 discounted back 5 years as well. All right. The bits we don't know consists of my net income combined with my depreciation in each year, discounted at 16% as well, and I'm going to operate this thing for 5 years. Remember, this expression is accounting for all 5 years worth of net income. All right? So it's an annuity. We're assuming it's the same amount every year. It's happening this many times, right? So now we have the present value of the cash flows we do know, the present value of the cash flows we don't know, but we are, by assumption, knowing that they are 0 in sum total, right? So now it's just a matter of solving for that exact expression here. So in particular, we can say that this number, the numbers we do know, are negative $803,818. And now let's just solve for my net income and depreciation. So step 1, add this to the side with 0, so we know 803,818 is equal to the present value of my net income and depreciation every year. So then solve for just this piece here, 803,818. That's too many ones. Times 0.16, multiplying this piece through, divided by this piece, 1 minus 1 over 1.16 to the fifth. This gives me 245,494, right? So this piece is my net income and my depreciation together combined. That number is sometimes called operating cash flow, just so you know. If we think about sort of how much money we're making from regular operations, it's my net income plus my depreciation, because that's what's coming from, making money, spending costs, generating that money, etc., paying taxes, sort of regular ongoing things. The rest of these are kind of one-off special things, right? We're not spending hundreds of thousands of dollars on CapEx every year. That's not our business. Our business here is making machine screws. The cash flow reflected from that is the net income and the depreciation, again, our operating cash flow. So now it's just working our way back up the little income statement portion. In particular, net income plus depreciation. Depreciation is $156,000, you'll recall, it broke. They make weak caps for these things. 245,494. So our net income then is 89,494. All right. So now I can come back over here and say, well, this is true in each year. Net income is 89,494. Again, that's true every year. So we only need to do this for 1 year, right? We just need to keep in the back of our mind, this is what's happening in each year for 5 years. We know that this is coming from what's left over after we pay 35% in taxes on our taxable income, right? So our EBIT, we don't know, but we do know how much is left after we pay those taxes. Again, in the case in which we're breaking even. So we can find our EBIT by dividing both sides by 0.65. So this means that our earnings before interest and taxes is $137,682. And then we know that our EBIT itself comes from our revenue minus our costs. Our variable costs are $1,275. Our fixed costs are $240,000. And our depreciation is $156, right? That's how we normally calculate EBIT, which tells us that this is $1,275 on down. Tells us that the revenue must be this plus 156 plus 240 plus 1275, which is $1,808,682, which we know is coming from selling 150,000 cartons of machine screws. And that then is our final step. We say, look, I need to generate $1,808,000 dollars by selling 150,000 cartons of machine screws at some price. So that price is $694 over 150,000. That's enough zeros. So this is $12.06. So this is what we're ultimately after. But